Good afternoon, good morning, and good evening to you all in one. This is Rustin Edwards and my illustrious co-host, Mr. Matt Stanley, and another
Welcome.
exciting episode of The Smoking Barrel.
Yeah. Welcome, everyone. No, it's good.
Season 4, almost mid-year, almost mid-summer.
We were just talking about that before we came on today, is that nearly halfway through the year, and we're actually going to do, whether it's next week or the week after, we're going to do a review of the first half of the year because, you know, we'll touch on it in more detail, but, you know, what oil forecast demands look like versus actuals, what people thought about, you know, what's happening with Bab el-Mandeb and the wars. It's been a bit of a crazy year. It's been a very fast one. I know I sound like an old man saying that. That's only partially true, but
Because we're all getting older every minute.
yeah, exactly. So yeah, welcome back. Yes, you TSB, you Smoking Barrel legends.
First off, I'd like to say happy Eid al to all of our friends celebrating that feast holiday. And also
Yes,
a happy Juneteenth to all those in the United States celebrating that federal holiday.
yes, yeah. Eid Mubarak to all. I was actually off yesterday and Monday, so holidays here in Dubai. But so much going on, isn't there? We had the US Open golf on. For those who are into sport, by the way, this is still an energy podcast, by the way. Before I ramble on about sports crap, but yeah, the US Open on this weekend when Rory choked, and then you got the Cricket World Cup going on in the States.
Yeah.
Cricket,
Which
cricket in
I'm
America.
amazed that
Yeah,
gets no headlines whatsoever in the U.S. press.
well, cricket in America. I know what's next. Um, and then you've got the
Football? Maybe football? Oh wait, they have soccer. Oh.
no, it's definitely football, proper football. That's going on in Europe at the minute in Germany, and then you've got tennis and you've got the Olympics coming up. It's just the summer that keeps on giving.
It's a sportsman's paradise this year.
It is, but you know, sod sport. We can talk about that at a later stage, probably down the pub. But
Well, that's probably one of the reasons why European productivity is down or projected to be down because it is the World Cup and everybody's going to be in the pub watching the football matches all afternoon and into the evening.
and why not? I should be doing this very thing this afternoon, Edward. So don't feel too sorry for me. I'll be talking business, of course. Head of market engagement. I have to engage with the market. It says on my business card to engage with the market, so I'll be doing that down the pub. No, but look, where were we 2 weeks ago on Brent? We're trading this morning 85.03 for August. Brent down a bit on the day, not by much, 0.3%. But this time, let's go to the 5th of June. $77.18 we were, Edwards. What has happened? $8, market's up 10% in 2 weeks. What happened?
Well, I think that's just a case of people trying to get ahead of themselves, trying to figure out where forward demand looks like. There's been a lot of bullish projections that, going into Q3, Q4, we'll have massive demand increases. And so people are putting on their speculative trades and hope that it happens because it is flying in the face of the fundamentals.
Yeah. Yeah, I mean,
You
look,
have stocks building across different areas around the world, across different product bases. Yet here we are in the middle of summer. You have backwardated gas oil markets in Europe. Crude oil backwardation has increased massively because I think that's where a majority of the trade is putting the risk on is more on the time spread than on the flat price. But nevertheless, when you bid up the time spread, the flat price goes up with it.
yeah, absolutely. I mean, the more well, more devout of TSB follower would note that we did say look at August October Brent structure, which was a spread, the time spread that you were saying. So the difference between the price of Brent in August, between the price of Brent in October, because we see such strong drawdowns of crude in the summer, which is happening.
Well, but again, I think that also depends on what your demand profile looks like. And I've always been a drum beater that a lot of people are overestimating the actual amount of demand because they discount the amount of efficiency and the EV penetration that's happened around the world and continues to happen today. The
Yeah,
naysayers in the EV market will point to, oh my God, look at all the all the major production companies that have pulled out of the EV space or they've reduced their EV companies. But nevertheless, EVs are still being a point of contention. And if the US and Europe weren't so worried about it, they would not have put tariffs on Chinese production. They would
yeah,
have allowed the Chinese competition to come in.
yeah. No, I agree. I mean, it's anecdotally here in the Middle East, I mean, you're seeing quite the EV penetration for things like, the government run transport agencies like the taxis and stuff. A Tesla was something of a, I mean, was something of a novelty, but now it's very much part of the sort of fabric you see on the roads. And then you've got the Chinese EVs coming in like BYD, etc., which I think are the world's most popular electric vehicle. But look, I think you're right in terms of forecasts going forward and how we can all save the dolphin and all that kind of crap, important crap. It's very much what's happening now this summer, how much oil there is available in the market because of the OPEC production cuts versus demand. And we are seeing this just under 2.5 million barrels a day of deficit, which means that stocks are being drawn, crude stocks are being drawn. And that's why you've seen Brent backwardation hit $1.45 August, October. When we spoke about this 2 weeks ago, we said we thought that was a buy. Not that we're recommended trades to anyone, but it was a good trade, and it's gone from 70 cents to $1.40. What happens as that rolls out with actual demand numbers versus forecast demand numbers? That's why we want to do that in a couple of weeks, right? But I don't know. At the minute, the market $77 on Brent 2 weeks ago. The market kind of went, meh. OPEC, what are you doing, bringing back more oil? And then 2 weeks later, the market's gone, oh. Yeah, okay, we know there wasn't okay, we know you got to bring back oil, but there isn't enough right now, so that's why flat price.
Well, I think there's plenty of oil right now. I think what you're seeing is a market reaction to investment bank reports that have shown an elevated demand profile that has not yet to materialize. And so, with that, nobody wants to be caught on a short space market going into what could be a high demand profile, but hasn't been shown yet. It's a lot of forecasted demand. It's not actualized demand. And there is a difference. So people are betting on the market, they're betting on the come that the 2 million to 3 million barrels a day of demand will materialize out of thin air. And oh my God, we will have drawdowns across the board. I'm still a believer that the IEA and the EIA have a much better grasp on what forward demand looks like. And they've been revising down their global demand figures for the balance of the year.
So someone's tired, aren't they, people? Jeez. Oh, yeah, that was a rant and a half. You should work for Citibank. They see oil at $60 next year. Jesus. No, fair enough.
Citibank had it right doesn't mean that you have to knock them down.
No, I'm not. I mean, it's a fair point. And, that's something I think, when market did sell off after the OPEC news, Prince Abdulaziz, His Royal Highness, Saudi energy minister, blamed the media for putting hyperbole around certain articles reporting on the meeting and what it meant and what the group's strength was, blah, blah, blah. Okay, I don't want to get into that. That's dangerous ground, dangerous territory, and I'm never been good at tact or keeping my mouth shut. So I'll stop now, right? But the way that the group's looking at it, I think OPEC. Look, we've said this so many times. It's within the nature of what they do to be bullish, to look at the oil.
They're long oil. They have to talk it up because they need the money.
Yeah. Look, if you ran an ice cream shop, you wouldn't say, no, it's too cold outside for ice cream. You'd go have some ice cream, right? Now, I'm not comparing OPEC to Mr. Whippy, but if you have something to sell, you've got to make sure that people try and buy it, and you do what you can. Who the hell has ever compared OPEC to Mr. Whippy before? Just random. Anyway, look, I think that's, in all seriousness, having a look at demand projections for the first half of 2024, and then overlaying that with how actuals have come in, that's not going to lie. And we can then see if OPEC for the second half of the year, will they start dumbing down their demand? I don't know. I just don't think they will do it. It's just
never ever dumb down their demand. I mean, if you look at the latest monthly outlook reports, OPEC is holding fast to their numbers, while the IEA has dropped their demand figures to a little bit under 960,000 KBD of demand growth instead of 1.5 million that they originally had at the beginning of the year.
Yeah.
And every month they seem to be pulling it back a little bit every month because they don't see it.
Yeah, look, go on. Sorry, go on. Sorry.
But it is a case of, do you want to be are you a glass half full or glass half empty type of point of view on this? And it is a case that I think, again, just like it did last year, because remember last year we had the same type of argument going into the second half of the year where you've had, the OPEC IEA spread started doing
Yeah.
this, and the market actually ended up being closer to the IEA than it was to OPEC.
Yeah, I just want to clarify one point there that the viewing public are going to want addressing, Edwards, is that, mate, our glasses are always half empty. That's always been a problem when we meet up. We forget what we say. No, no, no.
There's a hole in the bottom of them. What the hell?
Yeah, exactly. Another one. All right. Anyway, enough of. Don't get bogged down in that one. No, look, I think it's a good point, and when you sort of, pick between the details, U.S. oil production is plateauing. The Guyana barrels are coming into
Well,
the
it was
market.
up. It was up last week.
Yeah, but
Increased by 100,000 a day.
it's not as exponential as it was, say, last year, and that really is
Well,
the
it won't it won't be as exponential, but I think what we will see is we'll see a steady increase over time, but not exponential growth.
Yeah. Look, while we're on about the USA oil production, just moving on to another factor that the market is probably pricing in. I just want to share my screen with you, if I may. Look, I laboured the point, and I've laboured it quite a bit. Is about this season's the hurricane season in the Atlantic Basin, specifically the Gulf Coast. What it means, the change in trade patterns that we've seen because Russia being sanctioned, the Bab el-Mandeb Straits. Energy markets have never had to adjust as quickly as they have in the last 2 or 3 years, and very much, what's very much changed with it has been the dynamism of the oil trading market. So, the U.S. Gulf Coast used to supply lots of Latin America, so Brazil specifically for diesel and other countries as well. But now Russia are supplying those because Russia can't supply into Europe because they've been sanctioned. So you've got the US Gulf Coast refiners picking up a lot of the slack, as well as, say, the new Middle East refineries and the West Coast Indians who are picking up those barrels as well. It's taking longer to get there because they're going via the Cape. Although we did see an LNG boat go through the Red Sea at the weekend, which is the first one for a while. But just going back to the hurricane thing, if the US Gulf Coast does get shut in for a length of time, as many forecast, then it will affect European refining margins. Cracks will go big, but it's all go on. It's all about.
To add to that point, because the amount of WTI that exports out of the U.S. into Europe now, because WTI is now part of the daily Brent screen.
Yes.
Um, any type of delay you get in a hurricane impacting loading patterns out of Corpus Christi or out of Houston or Louisiana, will impact the supply of crude oil into the European refining space.
Yeah, absolutely. Can you see this?
Yep.
Okay. Here's our lovely Kepler terminal. The orange boats are liquids and LPG. You've got LNG and dry as well. But this is essentially a snapshot of what's happening here. Mexico, this is right now. This is not a named storm yet, but it's the potential tropical cyclone 1, right? This is obviously the map, and then these are the installation. These are vessels, not plugged in Kepler here. And then you've got the trunk. So this is where the storm is essentially going to make landfall. So right into Mexico and eastern Texas.
Just for clarification, the storm's looking to make landfall in the middle of Mexico. However, the waves of rainfall will extend all the way up to the coastline, all the way up into Houston. And so it will be a heavy rain event along the Gulf Coast for about 24 to 48 hours until the storm dissipates as it goes inland.
Yeah, so at the moment it's due to hit landfall. What we got in forecasted in 21 hours. Right, so what's happened is, let me just go back to something here. Insights, this is our research team. We'll probably get in trouble for this, but never mind. Where are we? US crude inventory draws. So this is what we've got here. It's my colleague, Matty Smith. He's brilliant. And then she wrote this yesterday. So here you can see the forecast release, 17 to 25 named storms, a hyperactive hurricane season. And look, like I said, the hyperbole is an overused term or overused thing. Not very clever, I told you. But it is important this year. But look what you got here. Several ports have been intermittently closed over the last 2 days, while others have temporarily suspended pilot services due to inclement weather. So look, if you can stop me sharing now, Russ, because I don't know how to get out of it. We can talk about it. Got it? There we go. See, we're tech people. Told you.
Well, I mean, the thing is that at this time of year, when you have a storm that forms in the Gulf of Campeche, if it doesn't develop into a full-scale hurricane, it usually comes ashore and causes a major rain event in the Gulf of Mexico. One thing that the people seem to forget is that Houston and Corpus Christi, they're kind of built on swampy land. And so whenever you get one of these major rain events, you get a lot of flooding, which usually can curtail traffic in and around the Houston metro area, refinery operations, and also impact Corpus Christi as well. So that
Right.
that's kind of where your major impact is going to be from this storm. From what I can see, is that you'll get a lot of rain. It'll be about a 48-hour rain event, and then Houston will have to drain out and dry off like they've done in the past. They're no stranger to a storm like this.
No, sure. I mean, do you think that because of the sensitivity around this subject that the market will overreact to a potential
Oh,
storm in the Gulf Coast this year?
I think a lot of people will overreact because it is, it's a tropical storm in the middle of the Gulf of Mexico. Oh my God, I think a lot of people will overreact. I think that's part of the reason why we've seen the rally in crude
Right,
that we've seen in the last couple of days is mainly because the storm is formed. And when it formed in the Gulf of Campeche, that's where the majority of Mexican oil production's at. And
right.
so if it would impact oil production there, that has just that knock-on effect to the marketplace. Now, as it's moved a bit north and it's now going inland, it will start impacting STS lighterings in the Gulf of Mexico and vessels
Right.
loading at docks, especially in Corpus Christi and Brownville. And so there you're going to have a slowdown in export capacity for a couple of days until the storm passes and dissipates away. So yeah, there is a validity to a rally on a potential storm event because there is one actively right now in place.
But I mean, the market loves this. It loves a sort of dramatic headline reacts. But if, say, for example, the storm peters out and there's no, and it rains a bit, but nothing too bad, does the market then adjust back down,
Oh, I
or
think
does
it
it?
does. I think it jumps back down towards $80 again.
Do you?
Yeah, and
Interesting.
also I think what you're seeing here is a sympathetic rally on Brent to that of WTI because WTI goes into expiry on the 20th, which is
Yeah,
tomorrow.
yeah.
And so you probably see some type of play going on in the Cushing area to push the market up, and that's just having a sympathetic event into Brent as well.
Interesting. Okay. Yeah, no, there's lots going on. I mean, we're hosting a few sort of webinar season. We've got a couple of webinars. I'm hosting a couple actually. We've got one that is coming Friday about freight, and then we're going to host one as well on the Dangote refinery in a couple of weeks, which I'll share more next week. But yeah,
Speaking of
freight.
freight,
Yeah,
freight's a
exactly. I
big
was going to say. Speaking of
freight's a great
freight,
topic.
yeah, tell us because
I mean, we had last week the FMOC meeting with the Federal Reserve holding interest rates where it's at. Yet,
yeah,
they intimated as the different Fed presidents came out and spoke that there would be potential for an interest rate hike in Q4, or I'm sorry, reduction in Q4, not a hike, a cut. And of course, that's put the market all in jitters. You see what's already happened with the 10-year U.S. bonds. The yields have come off as people have been buying up the bonds and thinking that we're at the top and it's got to come off from there. However, it's almost like the global rate reduction is almost failure to launch here because a lot of central banks are still holding their powder on cutting rates
yeah,
because their economies just aren't that stable enough to make it happen. Now, in the United States, if you look at the United States data, there's some good data, some bad data. Retail sales came out; they were fairly poor today. Employment data has been fairly robust. So it's a bit of a balancing act of how interest rates are going to work. And the
yeah.
one key factor that the U.S. Federal Reserve continues to look at is inflation and what's going on with inflation. Now, there was a downtick of inflation in the last reading. However, the one piece of inflation that is still, as I said, a leading harbinger of what's going to happen is freight, and especially freight on consumer goods. And I'm going to share a screenshot here from Trading Economics website showing the container freight index. And this is a 5-year chart. And
We
you can see we're currently at 33.79 on their freight index, which is almost to the peak of what we had on the post-COVID recovery.
wow. So the spike that we saw end of last year, beginning of this year, was down to the Baba Madeb issues, right?
Yes, so that was Baba Mondab, this little jump here to here.
Yeah.
And then we had a bit of a normalization, and now we've had this extra increase because of the issues around boxes not being in the right locations, people paying up for prompt shipping rates. You've got the specter of a potential port strike across the United States as the ILIA, which is the International Longshoremen's Association, which controls the majority of the major container ports in the world, or in the United States, sorry, not the world, the United States have threatened to go on strike because their contractual demands aren't being met as they continue with the negotiation process. But nevertheless, you're seeing this massive move in freight, which is going to roll into consumer good prices probably as we start getting into July and August, because that's when those goods will start hitting the shelves in the stores of your Walmarts, your Amazons, whatever, and they'll have to cover this increase in freight cost. I mean, there's some
Can
analysts
we
who are calling that we could see container rates get back towards the $20,000 for trans-Pacific routing, which is what we had back here when COVID was coming out, when the world was coming out of COVID.
can you just I just want to I'm reading that right. The top says containerized freight index increased 1,600 points or 92% since the beginning of the year.
Yes.
Okay, now this is really interesting. Going down to the bottom there, the Baltic Dry Index, that's up 84% on the year, Baltic Dry Index.
Yes, it is.
So where are tankers in to sort of close that circle? You've got boxes, containers up 92%. You've got the Baltic Dry Index up 84%. Where
I
would you
think
put tankers
tankers,
in that?
well, I don't think tankers are up as much just because tankers started the year at a very high base.
Okay.
So tankers are almost flatline, but they're at a very high TCE rate, $50,000 a day for a Suezmax. That's good earnings for most tanker companies. And I think if you look at as the earnings season comes out at the end of Q2, it'll be reflected in pretty much every publicly traded tanker company. But the rates are still good, very strong.
Yeah, look, I mean, I think that it's a hedge that a lot of people are putting on. I mean, I've got a friend or a business contact who's just sold his fleet to ADNOC. You could say it's a lot of money for a shipping company, but the way that these guys are looking to leverage now, the Aramcos with Bari and ADNOC, obviously with Navigate, you know, freight is the biggest ancillary cost on a trade, and I think that people are investing in it. The people who aren't investing in it are people like BP or Total in Europe. They're not. They're
They
just
are investing in it. I would say they are. They are investing in it,
are they?
but they're investing in it not so much in actually buying the ships, but actually getting into a long-term agreement with a freight provider so that the freight needs are covered. Because freight, as you said, is a big ancillary cost. And if you look at it from the wet bulk market, you do have a general tightness because a lot of the ships are getting older and you can't get a new ship until 2026, 2027.
Wow. Okay. Apologies, BP. Sorry, if anyone listening. Keep up the good work. But are you saying that talking about other trade ideas and potentials that are out there, the long-term freight play up until say 2030, a lot of people are interested in that. That's a genuine concern that you think that the market has not enough
Yeah,
ships.
yeah, I think it is because if you look at the aging profile of the current commercially tradable fleet, it is getting closer and closer to that 20-year drop-off date. And
Right.
then, and what happens after 20 years? That you become commercially untradeable to a
So they
lot of
get
people in the
fatter.
market.
Yeah. No, that's really interesting, and that's so. I mean, stick it out there. You see that contain that index that you just showed us continuing to increase, or is infrastructure
Good,
adjusting?
yes,
Or
it could continue to increase. Just because as people bid up for prompt space, markets go higher. And if you're bidding up for prompt space, that means that you have demand that needs to be met that's not being currently met through your long-term contracts. Now, my ultimate corollary to all this is that those increased freight rates roll into PPI numbers, which then eventually rolls into consumer price numbers, which
Yeah.
means to me that to sit there and say that we'll have a rate cut in Q4, it seems less and less plausible because that expense profile still needs to roll through the economy.
Yeah, I mean, look, it's a really good point, and I think that a lot it's a fickle world, isn't it? Because you look at inflation this morning in the UK, that dropped down to 2%, the Bank of England's target rate. That's the first time in nearly 3 years. But okay, so a lot of people will go, brilliant, right? Okay, that's all done. Back to where we were. Let's have a go, right? Have a day. And then because these shipping costs start coming in a lot higher, actually you might see inflation then bounce up to say 2.5, 2.6% again. And we're not back to square one, but you realize that, complacency, stability, is so fragile, isn't it?
Well, it is, especially as when you have a lot of other factors that are impacting cost structure that are hard to predict and hard to understand. I mean, say you have the Houthis stop attacking shipping in the Red Sea, that will be a massive boost to the economy. It'll be a detrimental impact to shipping
Yeah.
um, for the short term, but for the consumer, it'll be a great thing.
But it seems like, I mean, look, I know, you've moved on from the shipping industry, but you're still very much part of what you do. But um, you, it just seems like it's now what people will do is go around the Cape of Good Hope. It's priced in. Lots of people are going to do it. I know I mentioned we saw an LNG boat go through the Red Sea the other day, first one for a while. But essentially, I think that people have adjusted now that they're going to go via the Cape. I think even if they said, right, we're not going to do any of that. I think the things there again are so fragile. What's happening with Gaza, Israel, the Iranians, the Houthis, etc. I just don't think the shipping industry, shipping community would be as naive is too harsh a word, but would be as complacent to kind of go, well, everything's fine. We might as well go through the Suez again.
Yeah, true. I think the big case is going to be trying to get shippers to change their mindset because, as I've said many times, that the cat is out of the bag.
Yeah.
That the Houthis can make a impact a lot of demand profile for themselves by squeezing that strait.
Yeah, absolutely. Absolutely. Okay. Well, what do you think the week ahead? I mean, we got interest rate decisions out of the Bank of England later in the week. We got US stats or crude oil inventories and product inventories out tomorrow because it's Juneteenth today. I think
Yep.
for me, I think $85 is looking a bit fragile. I would expect us to sort of close the week in between 82 and a half and 85. There's not a lot, but structure is still strong on Brent, and I think that will continue. Um, and yeah, see what happens with all this demand data that apparently is going to come in so amazing.
Well, we'll also have the PMI data out for the pretty much majority of the world on Friday, so people can gauge what's going on with the manufacturing and service sector economy, which we still see that big split where service sector is outperforming manufacturing across the globe. Um, so I think that's still going to be a case in point that needs to be looked at as to how well that's going to impact energy demand going forward.
Yeah, absolutely. It's a demand week of joy, isn't it?
Well, the one
Let's
good thing
see.
about energy demand is that it's always going to be there. Just depends on what form it takes and how it gets manifested. I mean, it's summer is upon us. 40 plus degrees in the Middle East.
Yeah,
We've got high 20s, low 30s in Europe. So, break out those shorts and those tropical shirts.
there you go. You heard it from the man, people. Go and do that. All right, good to see
Well,
you, mate. Yeah,
um, we've enjoyed this one today. So everybody click like and subscribe.
yes.
Catch us on YouTube and on LinkedIn. Um, be speaking tomorrow at the Commodity Forum here in Geneva, talking about day in the life of a trader. So look forward to any of you out there in the audience.
Nice. Ciao.
Have a good one.